This animated diagram shows a classic currency pair stuck in a tight horizontal consolidation. For a retail trader, staring at this monochrome flatlining price action is an exercise in pure frustration. The natural impulse is to force a trade. Impatience kicks in, and traders start buying and selling these random microscopic fluctuations, slowly bleeding their capital on market noise. But markets operate on a continuous volatility cycle. They predictably alternate between these periods of extreme compression and sudden explosive expansion. That flatline is actually a liquidity vacuum. The market is physically accumulating potential energy as buyers and sellers search for a new fair value price. By treating this market silence as a warning sign rather than a dead zone, you step away from the chop and position yourself for the largest mathematical moves in Forex. To trade this effectively, we have to define exactly what quiet means using precise mathematical filters rather than relying on human guesswork. This diagram displays Bollinger Bands, creating dynamic boundaries for price travel. Next, we add Keltner channels, measuring historical average true range. The true squeeze occurs when outer Bollinger Bands compress and disappear inside the Keltner channels. This visual crossover turns a subjective observation into a binary signal. When those bands are encased, the price action is officially tighter than its own historical average, making a volatility expansion statistically more likely than continued silence. The squeeze signal comes with one severe limitation. It acts as an alarm for exactly when volatility will explode, but it offers absolutely no clue as to which direction the price will actually go. We use the MACD histogram below the flat price chart as a secondary pressure gauge. Forming higher lows on the MACD reveals hidden institutional buying pressure building to the upside, giving a bullish bias. But institutional algorithms often spike the price to trigger stop-loss orders in a head fake. To survive, apply the first close rule. Wait for a solid candlestick body to close completely outside the Bollinger Band. Pairing the MACD's directional bias with the strict discipline of the first close rule defends your capital against institutional traps, guaranteeing you only commit money to a genuine trend. This diagram shows the aftermath of a successful breakout. Green candlesticks break aggressively upward, riding directly along the expanding outer edge. To capture maximum distance, we use the 20-period simple moving average as a dynamic trailing stop. Relying on this moving average prevents premature exits during temporary pullbacks, capturing massive reward-to-risk ratios. Hold that position until you see the band curl. Watch the opposite Bollinger Band that was angling downward during the expansion. When that opposite band hooks back toward the center line, it signifies that the volatility expansion has peaked. The market enters a new consolidation phase, and it is time to bank your profits. Recognizing these cycles as recurring structural behavior rather than random events allows you to wait. You stop chasing the meaningless market noise and focus entirely on the compression that triggers these massive expansions. This image displays the FXNX digital workspace. Download our custom squeeze alert indicator to scan for these setups, open a 0.0 pip spread NX1 demo account, and journal your first 10 volatility breakout trades today.